You've carefully created a will, believing it's the final word on your life's assets. But for your largest accounts, like your 401k, your will may not be the deciding document. A single form you filled out years ago could send that money somewhere your will never intended. And most people have never gone back to update these forms. Here's why that happens: the most common mistakes and the 10-minute check that fixes it. So what is this document? It's the beneficiary designation form, and most of us don't remember signing it. You likely filled it out on your first day at a job, maybe decades ago. Since then, life has changed. This applies to 401ks, IRAs, life insurance, and bank accounts with payable on death instructions. The original reason for these forms is to avoid probate court, letting money pass directly to the person named. That's genuinely useful. It's also why the name on the form carries so much weight. When the form and the will disagree, families can end up confused at the worst possible moment. So why does the form usually win? Because it's an agreement between you and the company holding the money. Your will instructs your executor. The form instructs the institution directly. Once that form is on file, it carries real legal weight. Changing who receives the account generally means changing the form itself. This isn't a loophole. It's just how these accounts were built to work, which means you can't fix this in your will. You have to update the original form. Now that we know why the form matters, let's cover the most common mistakes. Mistake 1, leaving it blank. The money defaults to your estate, which sends it into the probate process you wanted to skip. Mistake 2, naming a minor directly. This gets complicated, and usually a court has to appoint someone to manage the money. Mistake 3, no contingent beneficiary. If your primary heir dies before you, the money defaults to probate again. Mistake 4, naming your estate. This sends it to probate and can create tax consequences for your heirs. Those are worth checking. But there's one more, and it catches people who thought they'd already handled it. It involves divorce. Imagine you get divorced. You update your will right away. But you forget the 401k beneficiary form you signed 15 years ago. Updating the will may not be enough on its own. Depending on the account and the state, the form on file can still decide who gets that money. This is common enough that estate attorneys see it constantly. It's also entirely preventable with one afternoon of checking. And here's the part worth sitting with. This form is not the only piece of your life that nobody has written down. Think about what else lives only in your head. Which accounts exist, who to call, how the house actually runs. The people who love you would be piecing all of it together at the hardest possible time. A beneficiary form is one small piece of that picture. A written plan is the whole picture. This is why a good will is only half of it. Your will and your beneficiary forms need to agree with each other. The good news is that the fix is simple, and you can start it today. Your action item. Log into every financial account you own. Find the beneficiary designation section. It takes minutes. Check your old 401s and IRAs. Check your life insurance. Check bank accounts for POD or TOD forms. Verify every name. One caveat, said plainly. This is general information, not legal advice. What to put on your forms is a conversation for your own attorney. Your will speaks for you when you're gone. Wayfinder helps you say the rest, so nobody has to guess. theindependenceplan.com/Wayfinder.